Hedge funds are investment funds that employ a wide range of strategies to generate returns. They cater to sophisticated investors, including high net worth individuals and institutions. One of the most popular strategies employed by hedge funds is the long-short equity strategy. This strategy involves taking both long and short positions in stocks. A long position is simply buying a stock with the expectation that its price will increase. A short position involves borrowing a stock and selling it in the market with the hope of buying it back later at a lower price to return to the lender. The profit is the difference between the selling price and the buying price. The long-short equity strategy aims to profit from both rising and falling stock prices. It seeks to generate returns that are independent of the overall market direction. This is achieved by carefully selecting stocks that are expected to outperform or underperform the market. Hedge funds employing the long-short equity strategy create a portfolio that includes both long and short positions. The long positions are chosen from stocks that are expected to outperform the market, while the short positions are selected from stocks that are expected to underperform. The goal is to generate a positive return, regardless of whether the market goes up or down. A key element of this strategy is the concept of market beta. Beta is a measure of a stock's volatility relative to the market. A stock with a beta of 1 moves in line with the market. A beta greater than 1 indicates higher volatility than the market, while a beta less than 1 suggests lower volatility. By carefully selecting long and short positions, hedge funds aim to neutralize the portfolio's beta. This means that the portfolio's return is not significantly impacted by the overall market movements. The focus shifts towards the individual stock selections and their performance relative to the market. The ultimate goal of hedge funds employing the long-short equity strategy is to generate alpha. Alpha represents the excess return earned on an investment above the market return. It is a measure of the manager's skill in selecting stocks and constructing a portfolio that outperforms the benchmark. Generating alpha requires in-depth research and analysis to identify stocks that are mispriced by the market. Hedge funds employ teams of analysts who scrutinize financial statements, industry trends, and economic data to uncover investment opportunities. They look for stocks that are undervalued or overvalued relative to their intrinsic worth. The selection of stocks for long and short positions is based on a variety of factors, including fundamental analysis, quantitative models, and market sentiment. Hedge funds may specialize in specific sectors or industries, developing expertise that allows them to identify mispricings more effectively. Leverage is a tool that allows investors to amplify their returns. It involves borrowing money to invest, which increases the potential gains but also magnifies the potential losses. Hedge funds often utilize leverage to enhance their returns from the long-short equity strategy. By borrowing money, hedge funds can increase the size of their positions in both long and short stocks. This amplifies the gains if the stock selections are correct. However, it also amplifies the losses if the selections are wrong. Leverage, therefore, introduces an element of risk that needs to be carefully managed. Hedge funds employ sophisticated risk management techniques to mitigate the risks associated with leverage. They set strict limits on the amount of leverage they use and closely monitor their portfolio's exposure to various market factors. Diversification is also crucial in managing leverage risk. Section 5. Hedge funds versus traditional banks, a leverage perspective. Hedge funds and traditional banks both utilize leverage, but their approaches differ significantly. Banks primarily use leverage to fund their lending activities, while hedge funds employ leverage to enhance investment returns. This fundamental difference stems from their respective business models and regulatory frameworks. Banks operate within a highly regulated environment with strict capital requirements. They are required to maintain a certain level of capital reserves to absorb potential losses from their lending activities. This limits the amount of leverage they can employ. Hedge funds, on the other hand, face fewer regulatory constraints on leverage. The use of leverage by banks is primarily focused on facilitating lending to businesses and individuals. The interest income earned on these loans generates profits for the bank. Hedge funds, however, use leverage to amplify returns from their investment strategies. Their goal is to generate alpha for their investors. A real-world example of the long-short equity strategy is a hedge fund specializing in the technology sector. The fund might take a long position in a company like Tesla, believing in its strong growth potential and innovative electric vehicles. Simultaneously, the fund might short a traditional automaker like General Motors, anticipating a decline in its market share due to the rise of electric vehicles. Another example could involve a hedge fund focusing on the healthcare industry. The fund might take a long position in a pharmaceutical company developing a groundbreaking new drug, expecting strong sales and profitability. At the same time, the fund might short a medical device company facing intense competition and pricing pressure, anticipating a decline in its earnings. These examples illustrate how the long-short equity strategy allows hedge funds to profit from both rising and falling stock prices within a specific sector or industry. By carefully selecting long and short positions, hedge funds aim to capture the alpha generated by their research and analysis. The long-short equity strategy is a powerful tool employed by hedge funds to generate returns independent of the overall market direction. By carefully selecting long and short positions and utilizing leverage strategically, hedge funds aim to capture alpha and deliver superior returns for their investors. The success of this strategy hinges on in-depth research, disciplined risk management, and a deep understanding of the markets and specific sectors. While it offers the potential for significant gains, it also carries inherent risks that need to be carefully managed. This discussion has provided an overview of the long-short equity strategy and its role in the world of hedge funds. It has highlighted the importance of alpha generation, the use of leverage, and the differences between hedge funds and traditional banks in their approach to leverage. The world of hedge funds is complex and constantly evolving. The long-short equity strategy is just one of many strategies employed by these sophisticated investors. Further exploration of other hedge fund strategies will provide a more comprehensive understanding of this fascinating corner of the financial markets. What are your thoughts on the long-short equity strategy? Share your insights and questions in the comments below. Let's delve deeper into the world of hedge funds and their pursuit of alpha.